We're here to talk about the Silicon Valley real estate market for the week ending January 17th. These are the key chapters we're going to be going over. Brief description. You can jump to the chapter you find most interesting. I'm Richard Calhoun, Creekside Realty, real estate broker working with buyers or sellers here in Silicon Valley. Appreciate you liking the video and subscribing. Here we have the first data slide and sort of a summary slide going back for the last quarter, 14 weeks, including the current week. Current week's over on the right-hand side. You have the current value of 1,080 listings in all of Santa Clara, San Mateo, and Alameda counties. So that's what I call Silicon Valley. That's 88% of where it normally is. You can see a quarter ago we had 2,600 listings, so clearly quite a bit more listings. But notice that the percentage of normal is essentially the same at 90%. How do I define normal? I look at the previous 10 years, which are 2015 through 2024, calculate what the median is, and that's what I define as normal. If you have long-term changes in the marketplace, it impacts my normal. And one of the long-term trends we've been having is less and less inventory and less offers every year. Even though the valley gets bigger, you just have fewer transactions. People are more stable. Silicon Valley is becoming an older community. Offers accepted, same exact concept. You can see we're now at only 842 transactions in the past 5 weeks. That's only 170 transactions a week, not a whole lot of volume, and that is 71%, 72% of where it typically is. A quarter ago, you were at 2,200 transactions, so almost triple the number of transactions, but the percentage wasn't that much greater. It was definitely higher at 84%. Days unsold inventory, this is sort of the supply-demand balance, this ratio between the number of sellers and the number of buyers. You can see we've been fluctuating on both sides of the gray line, which is the normal line. The red line is the hottest marketplace, which would be a very quick turnover, and the blue line is the coolest. 9% slower than it typically is. Again, nobody's in a sense that in general rough rule of thumb is I consider anything on about 12.5% on either side of 100 to be a normal marketplace. So this would be a normal marketplace. You'd sell out your entire inventory in 45 days. A quarter ago, that was 41 days. But back a quarter ago, it was a little bit faster than normal at 95%. So you're on the fast side of normal. Now you're on the slow side of normal. Another way to measure marketing time is simply how many days does it take for the offer to come in. And I measure this not on the median or the average that most people look at as statistics, but the 75th percentile. And that's the third quadrant, which is a fairly normal metric. But the reason I do that is half the sellers sell their property as soon as they're willing to take offers. So they come on the market sometimes this past week, and then next week they look at offers. That's going to happen no matter what kind of marketplace you're in. So therefore, I'm only looking at the 75th percentile. This is where the time it takes 3 out of 4 sellers to sell their property. You can see that's currently at 47 days. And you can see it's basically right at the blue line. So you're definitely sort of on the slow side. But we were a lot slower just 2 weeks ago. And now we're back down to only 114% of typical. So 14% slower than it normally is. You can see that that's getting to be significantly different than we were just a quarter ago, because you were at 92%, which is in the realm of normal, but on the low side of normal. And now you're on the high side or slightly above the high side of normal. You've gone from 25 days to sell 3/4 of the properties to almost 50 days. So it's taking almost twice as long to sell properties. I do expect this number to go down fairly quickly as we have the influx of 2025 properties coming on the marketplace. Ask price reductions. This now is becoming a very interesting metric in the fact that it's a very tight metric because the vast majority of sellers do their homework before they put their home on the marketplace. And with 47 days for 3 out of 4 sellers to sell, a lot of sellers don't even have time to reduce their price. In fact, if 50% of the properties are selling basically in about a week, which is fairly close to what happens, they don't have time to reduce the price. Another way to say it is about 85% of the sellers have no time to reduce their price. So you have 85% of zeros and only 15% of the sellers reducing their price. So even if they reduce their price by 10%, that's not coming out to a huge price reduction. And so in fact, seeing that you have less than 1% price reductions is not surprising. And that's pretty close to normal. It's only 15% higher than it typically is. So maybe normal is about 83 hundredths of 1% of a price reduction. And now it's at 95 hundredths of 1%. Is that really a change? It's hard to say. So I call that a tight metric. It really doesn't change very much. But you can see it's on the cool side of normal. A quarter ago, it was right at normal at 96%. 4%, you're not going to see that. 15%, that's starting to be a little bit On the cooler side, it's just outside that 12% range that I consider normal. Overbidding is a quarter ago was at 6%. Typically it's at 4.6%. So there was more overbidding as far as magnitude of overbidding than there typically is, which is why you're approaching the red line. You're not there, but you were close. Now you're closer to the neutral line, the gray line. You're at 4.7% overbidding, and typical is 3.3%. So overbidding does come down at this time of the year. So that's a quick summary. Let's get into looking at it over time. One of the things that I do that's fairly unique is from January 1st, 2024 back, you have what I call the condensed scale. The scale is about twice as condensed as it is from 2024 up to 2026. You have 2024 for a whole year, so you can sort of see what the expanded scale looks like, and then you're plotting the current data on that expanded scale. You can see we came out past the new year, and then there was abrupt change, and all these numbers are going up. So let's look at them. The purple line is inventory. You were down here at that 73% of normal. Now you're all the way up to 93% of normal. So inventory has shot up a lot more than normal, so that you're getting closer to the normal realm. Moving on to offers accepted. Offers accepted haven't come up as much. And I actually last week was sort of expecting it to sort of mirror the inventory trend. But when you look at the data that's coming up, even though I would have expected that, the offers do typically bottom out this week. So this is usually the week of the least amount of volume or close to it as far as new offers being accepted. Then you move on to the days unsold inventory, the gray line. You're now at 110%, so you're now slower than you typically are. So you've slowed down dramatically because you've had this big influx of inventory and only a small influx of new offers. So the real key is, what's going to happen this current week. We're going to have a little bit less new inventory because of the holiday weekend, and yet the buyers are still going to come through. But I would expect that this DUI is going to turn around and come back closer to normal for next week. Here's inventory. You can see that we're very limited inventory. You can see that we grew up our inventory. We're approaching, but we're still significantly below the gray line. We're maybe halfway in between the two, or maybe 1/3 of the way between, down from the level of normal inventory. Normal level of inventory would be the gray line. The most inventory you'd expect is the blue line. The least inventory you'd expect is the red line. And you can see basically since the pandemic, we've been closer to the red line than any other line for the vast majority of the time. Here's comparing to normal. So what I do is I pull out that gray line that's curvy and call that normal 100%. And then what is the percentage of the data today? And the data today is saying it's about 93% of normal. So inventory is only lacking about 7% of the inventory that it typically does for this time of the year. And this is the number of offers that have been accepted over the past 5 weeks. And you can see that we're right at the blue line. So we have the least offer you expect. But the more important thing is see how it's turned around and climbed up curved. It looks like it's bottomed out, and a week from today, I'll probably be reporting that we're coming back up on this curve. That's what I was saying earlier, that even though inventory shot up a full week ago, offers really don't shoot up until this coming week. So there's basically not the 1 week lag that I thought there would be based on normally listings turn over pretty quick. But at the beginning of the year, for whatever reason, there appears to be typically a 2-week lag. The number of offers accepted has been lower than normal ever since we had the slowdown. So we basically come back here to the pandemic, and which is right here, this extra unusual V. And then you had surplus number of offers accepted all the way through about Valentine's Day of 2022. And then it cooled down dramatically. And ever since that slowdown, we've been having fewer transactions than you typically have. We've been pretty close to the blue line ever since the middle of 2022. Here's the offers compared to the 10-year normal. So you can see it a little bit. Here's the COVID slowdown. Here you can see the big surplus right after COVID. And then starting around Valentine's Day, you can see the dramatic slowdown in the number of offers. And once that slowdown occurred, we've now been at the slower level of transactions. Here's the speed of the marketplace as measured by days unsold inventory. This is the ratio between the buyers and the sellers. You can see that you're slightly above the gray line, so you're having a slower than typical marketplace. Right now you're at 51, 52 days, which is still fairly fast. You're talking about selling all your existing inventory at the existing rate of sales if there were no new listings. So sort of a theoretical number is the turnover rate of the marketplace. So to turn the entire marketplace over in under 2 months is pretty phenomenal. Silicon Valley typically turns over in that 1 to 3 month time frame. That's why I measure a date based on days unsold inventory. You can see a lot of times down here we were at only 3 weeks, And sort of the highest numbers that we're seeing on this graph is about 70 days. So it didn't even get out to 3 months. So basically 1 to 2 months is sort of the typical range. Here's taking the gray line and stretching it out. You can see that we slowed down fairly dramatically, and that was because last week we had that large surplus of inventory, and we haven't yet had the corresponding increase in the number of offers. Based on the comments I made about 2 slides back, I would expect that to happen this coming week. So I'd expect this to reverse and come back down. And here's marketing time, simply how long is it taking 3 out of 4 sellers to sell. And you can see that this is actually turned around and come down, from about 46 days down to 40 days in just 1 week. And it's turned around earlier than it typically does. So typically it's another week out before this number really turns around. I think part of that's because we have had the low inventory, so that there hasn't been a lot of properties that have been on the market for a long period of time. But this is a sign that things are okay, that days on market are going down. Basically, when new listings are coming on the market all since the New Year's, none of them have had time to have large number of days on the marketplace, and that's why the number comes down so dramatically. You can see the gray line is a sort of a projection of what you'd expect in a typical marketplace for the market to do, and you can see that it's just plummeting, and it plummets every year at this time of the year. You just can go back. Your gray vertical line is your New Year's, and then you can see right after New Year's, a couple weeks after, you have a sharp V drop, and that's just because nobody wants to put their house on the market going into the holidays. They wait till after the holidays, put it on the beginning part of the year. The buyers come out of the woodwork. There's been no marketing time, and so boom, the time it takes to sell 3 out of 4 listings drops fairly dramatically. Here you can see the marketing time. So we've dropped significantly. We've gone from basically somewhere around 25% more than normal marketing time to now 5% less marketing time. So that's a swing of about 30%. And that's simply because the timing appears to be off a little bit for this year for whatever reason. Here's the largest price reduction. So in acknowledging that the vast majority of the sellers do no price adjustment at all, I'm ignoring 90% of the sellers and only looking at the sellers that are the 10% of the sellers that are taking the largest price reductions. You can see towards the end of last year, when people were trying to sell their property before the end of the calendar year, or just getting tired because they hadn't sold, they were taking more price reductions than normal. Basically now with the New Year's, they're taking right at the normal amount of price reductions. And that amount of price reductions at this time will be pretty small because most of the listings are brand new on the marketplace, and therefore sellers haven't had time to reduce their price. Here's compared to typical, so more than typical to basically right at typical. You're somewhere around 95%, so 5% less price reductions than typical. Now, just to show I'm not playing any games, I am showing what the average is. And again, you can see we're right on the normal nut line here. You can see we were taking a little bit bigger price reductions. And the reason I normally don't look at this number, I give it less credibility, is that you're talking about 1.2% price reduction, and now you're talking about 0.7%. That's pretty small, but yet it's a fairly stable index. You can see that it's got the same amount of sway as pretty much any of the index, and it's got a similar annual pattern. And that's one of the reasons why I put the data up here, so you can start seeing that annual pattern that we go through every year. And every metric has its own annual cycle, and it's unique to that metric. Here now we're pulling out the gray line, and we're seeing that we were quite a bit below normal. We're coming back up. We're not quite back up to the normal range, but we're approaching that direction. We can see mostly in this time frame, the 10% of the sellers that are taking the largest price reductions have been taking larger than expected price reductions, which is an interesting observation. This now is looking at the frequency of price reductions instead of the magnitude of the price reductions. So this is how common, how many of the sellers are doing their price reductions. The gray line, and it's the vertical distance, is where you'd expect the frequency to be. So if you go straight up, you might be expecting something like 17% of the sellers to be doing price reductions. And instead you're down here somewhere around 13 and a third of the sellers are doing price reductions. Again, I don't know any other word to say it other than a type metric. Moving on, here is the same concept. You draw the straight line, and you can see we went from more sellers than normal taking price reductions just before New Year's. We were just shy of 110%, called 108%, and now you're all the way down here where you're only about 73% of the normal number of sellers. So you're missing a quarter of the number of sellers. You went from 10% more than the normal to now 25% less than normal in rough numbers. Here's overbidding. Overbidding lags behind. You can see its turnaround happens later. As the market heats up here, the delayed factor becomes smaller, but it's still going to be at least 2 to 3 weeks. And that's because we don't know what the sale price is until escrow gets closed and reported. And so there is a lagging time. So that, this is on here. It's not a predictor. It doesn't help you understand which direction the market's going. It does help you understand how much pressure the buyers are feeling, because the buyers are not going to go up and overbid 16% over the seller's asking price if they're not feeling a lot of pressure to do that in order to be successful in being the one winning offer on any particular listing. Right now, we're slightly above the normal level, but we're definitely within the realm of reasonable marketplace. When you have big shoot ups like this, and even in 2018, this was a pretty unusual marketplace, even though you were still within the red line. The red line was really defined by the demand after COVID shelter in place. Same concept, pulling out the gray line, making it straight. You can see that we're having more overbidding right now. Buyers are overbidding just shy of 1.75% more than they typically overbid for this time of the year. Here's the frequency of that overbidding. So it's a little bit more common than it typically is. Typical at this time of the year would be down here somewhere right around 54%, and you're up here about 57%. So not a 5% more overbidding, more common overbidding than you'd expect, but basically you would call that a normal marketplace. There's got to be some fluctuation in the definition of normal. Here's the frequency. So if you were at 100% of normal, you're a little bit more frequent, and we're right at that 5% that I estimated on the previous slide. Here now is looking at the long-term appreciation of prices. This now is uniform spacing on your x-axis just so that you can have it. And I went back to 2014 and a little bit further back apparently. So you can see the pattern that you have. You have a downward V at the end of every year. It may move a little bit. You have a U here when we were in the pandemic, and then we had a flat spot just before the market crashed in early 2022. Then we returned to the normal pattern of the V. We have our V here, and now we'd expect prices to climb. The sloped line is sort of my freehand, what the appreciation rate seems to be. We have overshoot every year. So sometime in the second quarter, you sort of reach a peak and then prices come back down again. Right now, based on the long-term graph, it looks like a great time to buy. You're quite a bit below the line. You're at the low point of the U. But if you even purchase today, this is not where you're going to be closing, because you're going to be closing in 3-5 weeks down the road. This line will be back up to some degree. How high up? There's no way to know. Here's the monthly payments for the cheapest 10 percentile home in Silicon Valley. So you can see monthly payments would be about $6,300. For the median price home, it would be about $12,000 a month. And for the most expensive home, it would be about $25,000. This assumes that someone's using a 30-year fixed, high balance conforming money at the federal rate. And the federal rate average was something like 7.03 this week. Now we're doing something a little different. We're looking at the distribution of every property for the past year. And the purple line is the current data, but we're going to start off on the dotted line down here, the enlarged dotted line. That's where we were a year ago. So a year ago, the market for a lot of the sellers, because this is marketing time, basically 80% of the sellers was longer. For 20% of the sellers that were taking the longest time to sell, this year is longer than it was a year ago. So you do have a crossover. The shape is not always the same. It's less. In fact, you can see some of the dotted lines here at this time of the year, it sort of hits a kink in it, and the homes that are new on the market sell real fast. So this part drops down more rapidly. The concept is what we're going to do is we're going to jump 1 week at a time initially. Then after about 6 weeks, we're going to go 2 weeks at a time. It's my belief that real estate has a very significant repetitive cycle. So in other words, if we start off on the dotted line a year ago and then we go to the next dotted line, you can see which direction the market's going. That's which direction the purple line will go. Now, it doesn't have to go in that direction because past performance doesn't predict future performance, and it may go larger or smaller amounts, but it gives you an indication of what you'd expect at this time of the year. So let's step through and watch it. So there you next. So it's an improvement. There's another significant improvement, another significant improvement. So what that's telling you, then there's another one. So that's February 14th, February 21st. March 8th down here, March 22nd. Now we're going to speed it up and jump more rapidly. So what that's basically doing is saying for the next several weeks, you'd expect this days on marketplace to decrease. So the market's going to get faster and faster. Then you've been going through the summer plateau where there really isn't much change. And right now with the most recent solid lines, you can see the market's starting to slow down quite a bit. And you can actually see up here, we were slower and the market's already improved. So the last several past weeks were slower than the current week. So we've already started that improvement, and we will most likely continue that improvement in the weeks to come. Now we're looking at the largest price reductions, and here we're looking at a distribution. So we're going from 2.5%, and the reason I don't go down to 100% or 0% is you have data input error. So the 2.5% that I don't plot, some percentage of the data is entered incorrectly. So that might be 1%, it might be 2%. So by ignoring 2.5%, I get rid of that. I come up to 17.5%. So I'm basically looking at a 15% wide chunk of the market skewed to the top end. So instead of, like that on the earlier price reductions, I was looking at the 10% of the sellers. Here, I'm looking at 15% of the sellers, but they're offset by that 2.5%, which is why I go down to 17.5%, if that makes any sense. So the same concept as last time. The purple line is where we are this year. The dotted line, which is where we're going to start this graph off, is down here. So last year we were significantly cooler because this is the coolest line we ever had down here back on December 27th of 2022. The hottest year, and you can't get any hotter than that, was February 14th of 2022. So we had the best and the worst in the same year. And so let's step through and see what actually happens. So you can see that it's accelerating. It's getting closer to the red line up here. We're approaching some of the highest numbers right now, right around the middle of March. There's the peak, April the 5th, it looked like. And now you're accelerating rapidly down as you're cooling down, you're deaccelerating down. Now you're sort of at that summer plateau where things really don't change much. Now you're on the solid lines, the most recent lines. There's a huge slowdown on November 29th, right at Thanksgiving. And here we are back to the beginning. So now you have the purple line, which is the current data. This is where we were a year ago, much slower. So we're doing less price reductions than we were a year ago. Moving on and looking at overbidding. And again, this is a lagging indicator, but that does show the buyer competitiveness. Same concept as the dotted line is where we were a year ago. The purple line is where we are. So the purple line is slightly higher than that dotted line. But again, the concept is where is the market going to go? And it cools down for 1-2 more weeks. And then 3 weeks is back to about the same as we are now. 4 weeks is higher than we were. And then by 5 weeks, you're significantly higher. 6 weeks. So middle March, you're getting near the peak. There's the peak right there. Beginning of May 3rd, I think it was. Now you're slowing down. And now you're at the summer plateau, I guess I should call it. And basically, there's a long period of time in the summer where nothing really much happens. And then you're getting to the end of the year slowdown. So you're the solid lines. And you can see in this is where we are now. Now what we're doing is looking at county by county. So San Mateo County in the orange, Alameda County in the gray, and Santa Clara County in the blue. You can see San Mateo County is the smallest county, so it's got the least inventory, and it's always had the least inventory. Historically, Santa Clara and Alameda County have been close together and follow the same pattern. Right now, Alameda County has significantly more listings than Santa Clara County. Here's offers accepted. So even though Santa Clara has significantly less listings, it has the exact same number of offers. So it's got a faster turnover rate. You can't comment on San Mateo County just on these two graphs independently because it's so smaller, much smaller, and has no relationship. So now we do the actual math and look at what the turnover rate is. You can see Santa Clara, as expected, has the fastest turnover rate at 38 days. And then San Mateo County actually comes in 62nd place at 58 days, so significantly slower than Santa Clara. And Alameda County is the slowest at 61 days to sell your inventory. And I say slowest, but 61 days to sell your entire list of inventory is still fairly quick. That would be like a Safeway selling out their store in 2 months. And you never have a perfect mix. So it's, that's never going to happen because as the best properties get picked over, the sale rate is going to slow down, etc. But again, it's a theoretical number that tells you the turnover rate. And this gets away from the theory and simply how long is it taking 3/4 of the sellers to sell. So you can see in Santa Clara County, it's the fastest turnover and the shortest marketing time. We're now down to about 27 days to sell 3/4 of our inventory. And that's actually what the sellers are experiencing. So right now, 3 out of 4 sellers sold in 27 days or less in Santa Clara County. In San Mateo County, that's at 50 days. And in Alameda County, that's 58 days. So the magnitude doesn't match up with the theoretical rate, but they're both measures. This one's a little bit easier for the consumer to understand. Here's the magnitude of price reductions, and you can see there are very small magnitudes. Santa Clara County is less than 0.5% price reduction. San Mateo County is at 0.6%, and it looks like Alameda County is at 1% price reduction. So Alameda County is taking the largest price reductions and has the most inventory and the slowest marketing time. They have time to reduce their price. Here's the frequency. So how common is price reductions? Santa Clara County, only 1 in 10 sellers is reducing their price. In San Mateo County, it's about 11%. So that would be 1 in 9 sellers reducing their price. And in Alameda County, it's about 17.5%, which would be about 1 in 6 sellers reducing their price. Here's the magnitude of overbidding. So we're flipping over now and seeing what the buyers have felt the pressure. They're feeling the most pressure in Santa Clara County, overbidding by just about 5%. Alameda County in the gray is about 4.25%, and San Mateo County in the orange is about 3.75% overbidding. So if someone was asking $1 million, they'd be going in at $1,037,500. Here now is the frequency of overbidding. You can see the least frequent overbidding is in San Mateo County, with only half the sellers getting overbid. I call it a two-way tie for Santa Clara County and Alameda County at 58% of the sellers getting more than their asking price. Here's the long-term appreciation. San Mateo County has got the least amount of appreciation. It's somewhere just over 50% appreciation, and that's since 2015. Alameda County is in second place at something like 55% appreciation. And Santa Clara County has got the highest appreciation by quite a bit at something like 92% appreciation. Here's the pricing. You can see Santa Clara County right now is significantly higher than San Mateo County. That is an unusual pattern. It's only been going on for a little bit. We've had times when there's been this inversion, but the magnitude of the inversion has never been this large that I'm aware of. You've had smaller crossovers. You can see almost every time the orange line's on top. That's not currently the case, and it's off by almost $100,000. And then Alameda County is obviously the more affordable county down here. This is on log paper. This next slide is the same information on regular paper for those that prefer. It's a little easier to read the actual raw numbers. You can see in Santa Clara County, you're at 1.850, and in San Mateo County, you're at 1750. So that is the $100,000 that I was estimating on the previous slide here. It's pretty easy to read. And then in Alameda County, you're at 1150 for the median sold price. Here's the estimated payments. They're going to be in the same order because they all go through the same formula, assuming an 80% loan at the 30-year fixed, also putting in an estimate for property taxes and insurance. So this would be the total PITI payment. Here now we're looking at the micro markets. This is what I think is really important, because what's happening in one county is not what's happening in every county, and what's happening in the county level isn't what's happening in a given micro market area. For example, right off the bat, you can see Foster City, Redwood Shores here is blue, where the rest of San Mateo County is pretty much neutral in white in color. Foster City right now has 200%, so double the inventory that it would expect to have. Now, keep in mind, and Foster City is sort of unique in the fact that it's a fairly small micro market area. I really was not ever comfortable with it, but it really doesn't follow the pattern of Redwood City or the Bay City, so I didn't want to have it goof up the other good data. But by being so small, it's subject to a lot of fluctuations, and it does fluctuate. 1 week it could be a lack of inventory, and the next week with just a couple new listings, it could have a surplus of inventory. But the global takeaway here is you basically have normal levels of inventory, except right here in the heart of Silicon Valley in Santa Clara County, the central part of Santa Clara County. You have a significant shortage of inventory where we only have about 2/3 of inventory you'd expect to have. So that is a little bit of a shortage. Everybody else is sort of within that range of 12% on either side of 100%. Here's the offers. You can see a huge lack of offers across the Bay. And again, one of the areas that sticks out is that small Foster City range. It's red. So, if you were looking at the overall area, you'd say the market's slow. But if you were to go by in Foster City, that would not be the case at all. I have Silicon Valley at number up here as the total. So all three counties is at 78%. So we're missing just a little shy of a quarter of the inventory. In Santa Clara County, you're at basically 80%. In San Mateo County, you're at 81%. So very common, very consistent there countywide. And then in Alameda County, you're at 0.75%. So, and in Alameda County for the first three metrics, and this is the second one, I only have countywide data. So Alameda County has the biggest shortage of offers. You can see the offer, even if we ignore Foster City, Redwood City, for example, has 17% more offers than it typically does. So it's doing the best in the large areas. And then if you go into Los Altos and Palo Alto, it's at 48%. Two areas that are basically right over the county line from each other are dramatically different. One's 15% more offers accepted and one's 15% less offers accepted. And that to me is why micro market data is so important. Here's days unsold inventory, so the turnover rate, and this is comparing to normal. It's not that the market's hot or cold. It's the Santa Clara Campbell area and then Saratoga Las Gatas is having a higher turnover rate than it typically does, where your East Central San Jose, your Palo Alto, Los Altos, and your Daly City areas are having a slower than typical turnover rate. The coast is having a little bit slower, but close to normal. Alameda County is pretty much exactly normal. And then you can come over to the table and read what the numbers are, 110%. It is a little bit slower in Alameda County than normal, but it's within that 12% range. Now we're getting rid of comparing to normal and just looking at what the magnitude of the number is right now. So the red areas are fast areas and the blue are slow areas. In Atherton, 230 days to sell their inventory. That is slow. Even Los Altos and Palo Alto at 131 days. That's slow. I max out at 145 days. So Los Altos and Palo Alto isn't saturated blue, but it's getting close. And then you flip down to Campbell and it's at 19 days. So you're going to sell and that looks like it's the fastest area. You're going to sell all your existing inventory in 19 days. At the peak of the marketplace, that got down probably to like 8 days or something like that. And probably in Cupertino, if I remember correctly. So it is hard to get that number much below that because many sellers want to hold their property on the market for at least or approaching a week for buyers to get out there and look at it. Now this is marketing time. So this is the easier to understand metric. It's showing the same thing. How long does it take 3/4 of the sellers to sell? You can see in the San Mateo County coast is the slowest at 154 days. So this area over here on the coast is really slow, where you're taking almost a half a year for 3 out of 4 sellers to sell. And coming over to Atherton, it's not quite as slow, but 129 days. And then you turn around and you look at something like Cupertino, 9 days. So 3/4 of the sellers are selling in 9 days. Fremont looks pretty good at 11 days. So you can see there's a huge difference, a factor of more than 10, a factor of 15 almost, between Fremont and Half Moon Bay. Here's looking at the price adjustments. Half Moon Bay is taking the most price reductions where they're adjusting down 4%. And this is that average number that's normally really tight. And then the area that's taking the least amount of price reductions looks like it's up here on the Alameda Island and Berkeley, where they're actually raising their price 0.75%. And then you have Foster City 0, Los Altos 0. Fremont is taking 0.2% price reduction. Most of us are anywhere from 0.25% price reduction to 1% price reduction. Here's the frequency of price reductions. So red is very uncommon price reductions. Very few sellers are taking price reductions. And you can look at these numbers. 0% in Los Altos, 4% in Saratoga Las Gatas, 4% in Cupertino, 6% in Campbell, 8% in Milpitas. Very small single-digit numbers for most of Santa Clara County. San Mateo County looks like it's closer to 2-digit numbers, but still pretty tight. You got the space cities at 3%. So, here again is 2 cities right next to each other. You have San Carlos, Belmont, Burlingame, San Mateo. Only 3% of the sellers are doing a price reduction. Go next door in Redwood City, and it's almost 17%. So you go from 3 out of 100 to every 1 in 6 doing a price adjustment in the probably in the negative direction. And again, these are just examples of why it's so important to understand what's happening in the area that you're either buying or selling or just investing or already own and just tracking the marketplace. Here's the magnitude of overbidding. So you can see it's a more subdued. Cupertino Sunnyvale is the high at 11%. Morgan Hill is the low in Santa Clara County at almost 2% negative. The overall slow is the San Mateo County coast at 4% in the negative direction. So this means that the buyers are on the coast aren't going in and overbidding. They're going in and reducing the seller's ask price. So you have anywhere from a 4% price reduction here in Half Moon Bay to Cupertino Sunnyvale with an 11% increase in the seller's ask price. Here's the frequency of overbidding. So how common is overbidding? Most frequent is in Foster City. Again, that small micro market area at 100%. But let's look at Cupertino. Almost 79% of the sellers are getting an overbid. 79% of the buyers are feeling they have to overbid. Campbell, 71%. Down here in Berkeley and the island of Alameda, 68%. Fremont, 68%. So there's a lot of high overbidding. Milpitas at 67%. So the redder the color, the higher the magnitude, the frequency of overbidding. So you can have very frequent overbidding and the magnitude still be somewhat in line. This is the long-term appreciation since the last 9 months of 2015. I picked that period because it was a period of time when the market was fairly flat. The area that I'm seeing that has the highest appreciation is down here in Union City, Newark at 108% appreciation, Campbell at 105%, and then the slowest, San Mateo County coast, 36%. The expensive area is the Atherton Menlo Park, only 16% appreciation. So again, a huge impact on how you would have done depending on where you bought. To me, the way I read this is you basically had San Mateo County that before the pandemic was very sought after, close to work, close to the job centers. Job centers have been sort of moving south and east over time. And then with COVID, you had more remote working. And for a while, Livermore was really lit up, and now people are living with the commute and deciding that's something they don't want to do. They're coming back in, and sort of the affordable areas closer in are the real hot spots, and wherever the current hot spots are, because of compounding, typically have the highest overall appreciation rate. Here's the sold price, and instead of following the median only, which is the middle number, I follow the cheapest 10% and the most expensive 10% in any given area. So that you got a price range, a sandwich per se. You can sort of understand, if you know what your price range is, you can see what areas you can afford and what areas you can't afford very quickly, instead of them just having the middle number. It also is interesting because these extremes don't always behave the same as the middle of the marketplace does. But you can see the areas that are most expensive are still sort of the close-in areas. The outlying areas are the more affordable areas. Here's a summary with the geographical areas on the left-hand side, the monthly payments or the total purchase price on the right-hand side. You can pick the micro market areas that you're interested in, read across and get a feel for the conditions that you're going to experience in that particular micro market area. You can see something like the San Mateo County coast is basically blue all the way across. And then you can come up to something like Campbell, which is pretty pink all the way across. Campbell would be Campbell, Cambrian, Santa Clara, and Willow Glen. Here is the actual raw numbers for either Santa Clara, San Mateo, or Alameda County, or Silicon Valley as a whole. Some of the things that's happening, your new listings is coming up fairly quickly, as you'd expect, especially in Alameda County. 21% increase in the number of new listings. Total inventory available has gone up fairly significantly. Offers accepted actually went down in Santa Clara County, which is sort of not expected, up slightly in San Mateo and in Alameda County. Apparently, I would expect it to be this coming week again that we start seeing the offers going up. Days on unsold inventory, these numbers have increased. Normally, a 5 sway does catch my attention. At this time of the year, but with the holidays, it has such a huge impact on real estate. I'm not particularly concerned. I'll probably pay a little bit more attention, but I think it's just the calendar. You have oddities in your calendar no matter how you do it. I have elected to look at things on a weekly basis, but then again, where's that week are? Because my week is defined basically on March the 1st. I go forward 7 days at a time. So my week starts and ends on different days. Right now it's ending midnight on Thursday night. I get the data midnight on Friday. And the reason that's important is the data is updated all the time. Not everybody reports the sales exactly on the day it happens. And so the data changes. In fact, I go back and redo my data for a full quarter. So I'm not changing the range, but as the live database changes, my numbers change slightly as I get more or less data, depending on whether you're having transactions close or transactions fall apart. But you can look at whatever metric here you find most valuable for you and then see what the actual raw numbers are. This is up here just to show the number of offers accepted. Last week at 834, we were at all-time record low out of the past 25 years. This week we're just above, but at 828. But the 828, we're talking about transactions that fail. There's a reasonable expectations that there will be a few more sales reported, but we'll also start getting transactions that failed. So in a couple weeks from now, the 828 may actually go below the 802 from last year, and we may be again having the lowest record number of transactions. You can see for the previous 2 weeks we were there. I would almost expect the 828 will be the lowest. So we've now had 3 weeks in a row where we've had the lowest number of transactions in the past 25 years. The low volume makes me uncomfortable. Why is there so few buyers? Anyway, that's been Silicon Valley real estate market. We will be talking about the Greater Bay Area, 13 counties and 5 regions. I'd appreciate you liking the video. If you haven't already subscribed, please do. The blue YouTube link here gives you the archive of my past presentations. You can get there with less typing using the green root URL. That green root URL becomes important because you can join the presentation live Saturday morning at 9 a.m. by adding in 2025. If you want the handout, it's 67 of the 159 or whatever it is PowerPoint slides that I go over. It's the key ones. You type in the green root URL plus H 2025 0118 for the year, month, date. If you want any specific episode, you type in the green root URL, year, month, date code, or go to the blue YouTube link. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers here in Silicon Valley. Single agency on any transaction. Happy to discuss your real estate needs, either a buyer or seller or investor. Don't have any unmuted mics, so I'll move forward. I'm covering the Greater Bay Area. These are the 5 regions that we'll be discussing for the Greater Bay Area, covering 13 counties. Here is the inventory. You can see inventory has gone down and has come up in all 5 regions, which is what you'd expect at this time of the year. All you have to do is look at the past end of the year lines and see that every end of the year is the low point, and then it comes up very rapidly. And so we're now on this steep part of increasing inventory. Offers accepted, sort of interesting here. You've had an increase in the North Bay, the Central Valley, a very small increase, and then the other 3, Silicon Valley, the city, San Francisco and Marin, and the Central Coast are still slightly down or potentially flat in the case of Central Coast. There's a lag in Silicon Valley. Silicon Valley and the cities are probably the most still decreasing number of offers in the past 5 weeks. This is the days unsold inventory, the speed, the balance between buyers and sellers, increasing in all areas. I expect this to be turning around very shortly. You can see shortly after the first of the year, all in the past years, it's come down. You also came down after COVID. Right now, you're basically at or very close to the peak. You might get one more week, but I would almost expect next week to be down. Here's marketing time. This is the time it takes 3/4 of the sellers to sell their property to get the offer in the door. You can see in all the regions except for potentially North Bay looks like it's still going up and Central Valley looks flat, but your cities, Central Coast and Silicon Valley are definitely on the downward trend. And you would expect that as more and more inventory comes on the market with 0 days on the marketplace, those are the properties that are going to be selling. That pulls down all the days on market, including the 75th percentile that I measured here. This is looking at sellers' ask price reductions. You can see that they're all in the upward direction, which is getting closer to 100%. In a typical marketplace, I'd expect a very small price reduction. That's a 0.5% whether it's 0.5% or 0.75% is subject to debate, but the trend is up in all cases. And again, if you look back over time, at the end of every year is sort of the valley, and then it starts going up. Basically, sellers that are just coming on the marketplace are selling right away and don't have time to do a price reduction. Here's the frequency of price reductions going down in all 5 regions. North Bay looks like it may be flat, but again, if you look historically, they all peak right at the beginning part of the year. So the fact that they're coming down now is exactly what you'd expect. This is the buyer's overbidding. So how much pressures are the buyer feeling? Silicon Valley now is on top of San Francisco and Marin with the greatest magnitude of overbidding at 4.5%. San Francisco Marin is about 4%. And then the other three are very close together, very close to 100%. North Bay is about 1/3 of 1% up. Central Coast is down by 0.5%, and Central Valley is down probably by 2/3 of 1%. So not huge numbers, but that number you don't expect to change. The sort of the lowest number on here is about 2% decrease and a 10% overbidding. Buyers are very reluctant to go in and underbid by a large amount of money. They wait for the seller to reduce their asking price if the market is slow. This is the frequency of that overbidding. You can see it's most frequent in Silicon Valley, with just about 57% of the sellers getting more than their asking price. In the cities, it's about 46%. North Bay is about 39%. Central Valley is about 33%. And Central Coast is the least amount of overbidding at about 30%. So less 3 out of 10 sellers get more than their asking price in the Central Coast. You can see that this pattern isn't as significant, but the frequency starts increasing, but it increases several weeks after the first of the year. And the reason for that is the offers that are being negotiated right now, we don't know if they're being sold over or under asking price until those escrows close, and that's what creates the lag time. So it's going to be a couple more weeks before I'd expect this number to turn around, but I would expect it to turn around. Total appreciation cities, San Francisco Marin is doing the least well, and you can see the change really happened back here with the pandemic. Prior to the pandemic, they were all fairly close together. The purple line, Silicon Valley, was probably on the top, and now Silicon Valley is close to the top, but there's basically close to a three-way tie. Central Valley is doing the best, and that's because of remote working, most likely, with basically something like 85% appreciation. Silicon Valley is somewhere around 75%, or actually 76% appreciation. Central Coast is about 68% appreciation. North Bay is around 58%. And then despite all those numbers being that high, you come down to San Francisco and Marin, and it's about 21% appreciation since 2015. You can see the cities is basically back to the level they were all the way back to about 2018, if you just draw a line straight back. The gray line here at 20% appreciation, you come back here, and you have to get back to sometime early in 2018 was when it first reached that price. So they've seen no appreciation after the first 3 years in this time period. Here's the actual sold price. This is the median. So Silicon Valley now has the highest price, higher than the cities. That has happened a couple times in the past. This is probably the largest magnitude. So not only is Santa Clara County more expensive now than San Mateo County, Silicon Valley is more expensive than the cities. Central Coast is in the middle at just over $1 million. North Bay is around $750,000, and the Central Valley is just over $500,000, about $550,000. This is the monthly payments. The order is the same. It assumes an 80% 30-year fixed at the national average, which I think was about 7.03%. Here are the numbers, the metrics going across the top, the different counties coming down the left-hand side. I do have the region for Silicon Valley and the Bay Area. I will caution, just like I think county data is too big, regional data is far too big. And the only reason I put in the Bay Area data in there is because the media reports on the Bay Area data. But all you have to do is pick any metric and see how widely different the numbers are. I'm landed on frequency of price reductions, 26% overall, but it's a high of 47% in San Francisco and Marin. Almost 1 out of 2 sellers is taking a price reduction. And then you go down to something like Santa Clara County at 10%. And there's no way those are even in the same league and don't reflect 26%. In fact, there's basically a couple groups. There's one group down here in the teens in Silicon Valley. Then you have, and you could even put in San Francisco. Then you got a group here for probably around 30. And then you got a couple outliers around 45%. With that, we're finished with the presentation. These are the chapters. You can jump to whatever chapter you find most interesting. I'm not seeing any unmuted mics. So that concludes the presentation for Saturday, January the 18th. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers here in Silicon Valley. Have a great week. Take care. Bye for now.